Hello everyone, this is Dr. Tao's Quant Lab. Today we begin section 1.6, Position Mechanics and Terminology. Before we discuss complex strategies, we must define the fundamental atoms of trading. We need to understand the instrument itself, the granularity of the data we observe, and the hidden mechanics of how prices are actually determined. First, let's look at data granularity. Financial data is continuous, but to analyze it, we aggregate it into discrete time frames. Let's look at a real trading interface. You see these buttons here from daily, weekly, monthly, or 1 minute up to 30 minutes. And we can go up to seconds. For 1 second, 5 seconds, up to 45 seconds, this is the microstructure level. Unless you are an algorithm or a high-frequency trader, you will rarely use this. It is mostly noise for humans. And that is the strategy 4 we talked about in section 1.1. Then from 1 minute up to 4 hours, this is the intraday level. This is where day traders live. You use the 1 hour or 4 hour charts to see the trend, and the 5-minute chart to execute the entry. Okay, that is the strategy 5 we talk about in section 1.1. Then the daily, weekly, monthly charts, they are the intraday level. If you are a swing trader or trend follower, like we focused on in this course, this is your home. Why? Because the daily time frame filters out the random noise of the minute-by-minute fluctuation. Let's go back. Although modern apps allow you to see every second of trading, remember, noise increases as the time frame decreases. In this course, we focus primarily on the daily close. It offers the best balance of signal to noise. Now, regardless of the time frame you choose, every unit of time is summarized by 4 key data points: open, high, low, and close, or we use OHLC. So let's use a daily trading for an example. So the market starts here and goes something like this and close at 4 p.m. from 9:30 to 4 p.m. Then the opening price is the first traded price of the period, which is right here. And the closing price is the final traded price of the period, which is about here. And the high and low price will be the highest price reached during the period, and then the lowest price reached during the period respectively. Okay. And then one more thing is for the volume, which means the total number of shares traded during the period. Remember that the price tells us what happened. Volume tells us how strongly it happened. but we will cover volume in details in chapter 2. Let's break down what this for really mean psychologically. The high and low prices represent the extremes of emotion. The high is the maximum grade of the day. The low is the maximum fear. The open and the closing price, these are the most critical. And if we look at a real example, so this is the NVIDIA stock price movement on February 11, 2026. So it opens around here, 192, and close around here, about 190. And the highest price of that day is around here, and then the lowest price is around here. So for each time, for each K line, right? For each, we call it OHLC chart, we can have these 4 important numbers. And here's something many beginners don't know. They assume price is just a continuous stream. However, the open and the close are determined by a specific mechanism called a call auction. At 9:30 a.m., the exchange doesn't just open the doors. It aggregates all the overnight trade orders, news, and earnings reports to find a single equilibrium price. This is why you see a gap on the chart. Let's see. If you look at here, the closing price on February 5th is 171. Then the open price on the next day, on Friday, February 6th, is 176. So there is a gap from here to here, and that is very common. So let's go back. Okay. So the price didn't jump magically. The market repriced the company's value while you were sleeping. Similarly, the closing price at 4 p.m. is determined by the closing auction. This is the single most important data point of the day. Why? Because it is used for mutual fund and ETF calculations, index rebalancing, like the S&P 500, margins calls, and collaterals checks, and etc. So in conclusion, because of these auctions, we can say the opening price represents the market's initial expectation. The closing price represents the market's final commitment. The movement between them is just the intraday battle. Now that we understand the data points, how do we visualize them? In the next video, we will introduce the most powerful visualization tool in technical analysis, the K-line or candlestick.